What is going on, investors? Hopefully, guys are doing well out there. Time to catch up on some earnings reports that we missed over the past couple of weeks. So we're going to combo up Walmart, Target, and Costco. The one thing that I don't want you to do when you view a video like this is think that all of these companies are in competition. Now, in some ways they are, but as an investor, you don't really have to look at this like Democrat versus Republican or Lakers versus Celtics. At any one time, you could own all three of these stocks. In fact, I've done that before. I've owned Walmart, Costco, Target. I've even owned Amazon all at the three times. Now, at the current time, I only own Costco and Amazon, and then some ways when we go through these financials, you'll see a little bit of a reasoning behind that. But we'll kick things off with Walmart. We'll move on to Target, and then we'll move on to Costco. There are timestamps if you want to jump around to the company that interests you the most. Let's kick things off with Walmart. Over the last year, stocks basically flat. Year to date, though, this company has not caught that wave that a lot of kind of that oversold or that tech trade that really blew up last year. A lot of those stocks are up double digit. Walmart not catching that. This stock's actually down 2% year to date. The company reported their Q4 earnings back on February 21st. They came in with revenue at $164 billion. That was a very impressive 7.3% year-over-year increase on those earnings, and that beat expectations by over $5.38 billion. They also gave us Q1 outlook for net sales to come about 4 to 4.5% adjusted for constant currency. When you come over here and look at the outlook for the company, that's about where Wall Street is at. They're actually expecting a little bit more upside into Q1 at about 5% growth on those net sales to come in at about $147 billion. Now, the company hiked their dividend by about 2% to give you about 57 cents per share. You're getting about $2.28 for the full year, 57 cents every quarter over at Walmart. That's another reason why you kind of tend to buy and hold this type of stock. They're rebuying the stock, and they're also paying an increasing dividend, although kind of a fractional increase. Now, the CEO of Walmart plans to stay on for at least 3 more years. So if you like the job that he is doing, which when you come over here and look at the financials and look at the trajectory of this company, and certainly you look at the trajectory of the stock chart, guy's doing a pretty good job. So I would actually be excited about that. Walmart to double its healthcare center footprint sometime in 2024. So my guess is they're seeing some benefits in this rollout as it's relatively small. I mean, it's 75 centers across the country by the end of 2024. For most businesses, that's a lot. For Walmart, which has hundreds of locations, not necessarily a large footprint yet, but if they're seeing progress there, certainly beneficial for shareholders. Now, Dick's Sporting Goods agreed to buy Moose Jaw from Walmart, which is actually a relatively small retail operation, just 7 retail locations across the country, but the company described it having a thriving e-commerce business. So Dick's Sporting Goods going to take that off the hands of Walmart, and Walmart is going to boost wages and employee perks. So what we're seeing in the tech sector is companies like Meta and Google and Microsoft and pretty much anybody involved in tech is actually going to be able to lay off workers and actually strip away employee perks, stuff like working from home, stuff like lunches in the office, stuff like those kind of lavish lifestyle those tech employees have lived over the past, we'll call it maybe even decades, certainly over the last couple of years. They're able to slash that in the tech sector. So those white collar workers, if you will, they're actually experiencing the opposite of the blue collar worker. There's actually a shortage of those blue collar workers that want to work on the floor of a Walmart. So Walmart's actually having to raise the wages up to $14 per hour. They're expected the hourly wage across the country to be more than $17.50. That's obviously going to put a crimp on earnings unless Walmart passes those prices along to the consumer. Now we come over to the financials with Walmart. We had that $164 billion worth of total revenues, we're talking about a very impressive 7.3% year over year. I think the thing that jumps off the board on the revenue side for Walmart is this membership and other, which had been on fire when it came to Sam's Club. We're actually seeing a little bit of a decline here. So that actually declined 3% from $1.4 billion down to about $1.3 billion. You see, for the full year, you're up 8.3%. So is this a 1 quarter anomaly for Sam's Club, or have we kind of topped out in Sam's Club and we're more on this kind of 1.3 run rate for the foreseeable future. Certainly we'll see that in subsequent quarter for Walmart. That'd be the first thing I look at when they report their Q1 earnings a couple of months from now. But very strong earnings side. Okay, despite, I mean, look, if Sam's Club was firing on all cylinders, the stock probably would have skyrocketed. Now, the story with Walmart, as we talked about, they're having to raise wages. They're fighting food inflation. They're fighting goods inflation. Well, you notice down here, your cost of sales up 8.6%. So when your total revenues go up 7.3%, that's great, right? Well, unfortunately, the cost of those sales rose 8.6%. And then you got your operating, selling, general administrative expenses. It's a lot of your labor here. That's up 5% year over year. So your operating income, despite the very strong revenue growth, was actually down 5.5% from about $5.9 billion down to, we'll call that $5.6 billion. You come down here to the debt side of the company. They're running at about a $520 million worth of interest that they're paying. They do earn a little bit of that back based on the cash that they have in. All in, you're about $500 million a quarter in terms of interest on the debt payments. Pull all the way down to a diluted income per share. You're at $2.32 for the full year. You're closer to $4.27. Again, we talked about the dividend. You're getting $2.28. So the company, from a dividend perspective, dividend coverage perspective, very, very well positioned. You come over here to the balance sheet. Cash has left the building over the last year. They had considerable more cash last year, but not something I would be over concerned about with Walmart. From an inventory standpoint, they've done a nice job year over year, basically flat on that inventory. So they are obviously at an elevated inventory standard, but it's not continuing to increase. So the company's gotten in front of that and done a nice job. From a long-term debt perspective, very much flat year over year. They do have about $4.1 billion, call it $4.2 billion due over the next 12 months. And come over here to cash flows, actually paints a pretty darn good story for Walmart. Net income was 11.3 this year. Last year was closer to 14. You get all your add backs and subtractions, and you come down here to net cash provided by running Walmart and Walmart.com. $29 billion of cash flow for the full year. Last year, you were at 24. So despite the increase of operating expenses and despite the decrease in your net income, your cash flows actually accelerated over the last year. In terms of reinvesting into Walmart centers and building new ones, you increase that from $13 billion up to, we'll call that close to $17 billion. Now, here's the all-important financing activity. So they issued some long-term debt to the tune of $5 billion. They repaid about $2.7 billion of that. They paid $6 billion to shareholders in the forms of dividend. You repurchased nearly $10 billion worth of Walmart stock. So over the last year, you decreased the amount of cash that you had by about $5.7 billion. The vast majority of that, in fact, you could almost attribute all of that to the company buying back the stock. When we look at Target in a little bit, that company actually probably should pause its buyback, if not get rid of it altogether. Walmart, from a cash flow perspective, certainly can afford this for a little bit of time. I think they probably will have to rein in the buyback over the next year or so, as they are, and I want to say depleting this cash, but this cash is starting to diminish just a little bit. And with where interest rates are, you don't really want to pile on some new debt onto the company at a very expensive rate. Now, from a technical perspective with Walmart, very interesting technical formation. Now, since 2016 or so, the stock was locked in, we'll call this blue upper trend. It broke that. That's typically a pretty bad sign when a stock breaks kind of a long-term trend. Now, it back tested all the way back to that blue line, which I conveniently erased, and it kind of started a new uptrend. What I would look at with Walmart is you're really in this sideways consolidation since about 2019 or so. The low end is down here. We'll call it like 120-ish. The high end is not far from where the stock is right now, up at 150. So this area at 140 with Walmart, not necessarily a place where I would be a buyer if you were, trying to lighten your load in the retail sector, or you want to raise some cash and buy some other stocks. Honestly, this is an area where I've sold Walmart in the past, and I've bought it down at these lower levels in the past. I suppose it's possible Walmart could have some kind of bullish move out the top of this channel. If it does that, that's fine. That's not a big deal. You should eventually get kind of a back test to the top of the channel. That would be an area where I would buy it at this elevated valuation. But until Walmart can prove that over the last 2 years, it can bust out meaningfully over the 150 price share, I would assume that it's going to get rejected at this level and probably back test, maybe not all the way back down to the 120s, but you get anywhere south of 130 on this one. That would be where I'd be interested if you're into accumulating Walmart or you want to start a new position or, again, add to an existing position. That's personally where I would look to add for Walmart. Right now, it's above that range. I would continue to be patient on this one. Your opportunity to buy it will likely materialize in the coming weeks and months ahead. Hopefully you enjoyed Walmart. We'll move forward onto Target. Over the last year, this stock hasn't fared nearly as well as certainly Costco and definitely Walmart as well, as it's down over 25%. But year to date, it has performed a little bit better than most of those stocks, up 9%. The company reported their Q4 earnings back on February 28th. Revenues came in at $31.4 billion. That was just 1.3% increase when we look at Costco, and certainly we looked at the 7% increase over at Walmart. A little bit of a disappointment when it comes to Target. Now, the company did give us guidance for the upcoming quarter as well, and it was actually kind of odd, and I had to go through and read through the conference call to see if management gave a little bit more guidance for the reason why they're offering a very wide range when it comes to their comp sales for the upcoming Q1. The company's expecting either low single-digit decline or low single-digit increase. That's pretty big. You don't normally see that with a company as large and as actually steady as Target tends to be. You tend to get more exact guidance. So some very much uncertainty when management gives you that. Now there's upside there because there's definitely going to be people, the stock actually sold off pretty rapidly after these earnings reports. And so there's going to be some investors that don't want to deal with that uncertainty. If they come towards this low single digit decline on those comp sales, well, the stock's probably not going to do well for the next 3 to 6 months. But if they come towards the high end, and certainly if they come over that, that's going to be an upside surprise for Target. And so some analysts on the conference call tried to get management to reason, like, is that why you're doing this, to kind of sandbag, if you will, and give that upside surprise for those subsequent quarters? Now, when you look at the revenue estimates for Wall Street, they're a little confused too. They're stuck at about 1%, or we'll call it closer to 0.75% to $25.3 billion. Again, we're coming off a fourth quarter with a holiday season at about $31 billion. Now, Target drew a downgrade from Wells Fargo. This was actually back on January 4th. And again, they released their earnings report on February 28th. So I would actually say that not all analysts have their fingers on the pulse of the company, but it appears to me that Wells Fargo actually had pretty solid information, as they said the outlook has deteriorated meaningfully over at Target. And I think we certainly saw evidence of that with that Q1 and certainly the full year 2023 outlook for Target. It's a little uncertain, and Wells Fargo did a nice job calling that actually back in January. So the next time you see a note from Wells Fargo on Target, it doesn't mean you need to believe the whole thing, but just understand Wells Fargo's actually pretty accurately predicted Target a month before they actually reported their earnings. So I'll definitely be paying attention to what Wells Fargo says about Target in subsequent quarters. Now, the company is going to invest $100 million to expand their delivery capabilities. So they're going to build these smaller kind of distribution centers. They already have over 15 of these across the country, or it believes they're going to have 15 by the end of 2026. This is going to allow them, when you order something on Target.com, to get it as fast as possible. Obviously, Amazon has pushed into that very much over the past decade or so. Now, moving over to these financials over at Walmart, you're going to see a company not doing great, honestly. You get your total revenues here. Those are up just fractionally, 1.3% year over year, from $31 billion up to, call that, $31.4 billion. Unfortunately, when you grow your revenues just 1.3% over a quarter and your cost of sales jump 5.2%, that's a problem. And on top of that, your selling general administrative expenses jumped 2.5%. So your operating income, despite the marginal revenue growth, those collapsed to the tune of 44%. Look at your operating income of the last year at Target, $2.1 billion, all the way down to $1.1 billion. That is what has Walmart Wall Street concerned? Because I talked about management at Target is expecting maybe a low single-digit decline in comp sales for subsequent quarter. So if you start declining your revenues and these cost of sales don't come under check, well, your operating income might go down even more. Look, for the full year, you're down 57% on that operating income side, from $9 billion, a very healthy $9 billion, all the way down to $3.8 billion. That is a major problem, and Target's going to have to address that in subsequent quarters. This is why when I was talking about Walmart doing their share buyback, this is a company that might have to put the pause on that relatively quickly. When we come over here to the balance sheet, it's not nearly as glorious as Walmart, and neither Walmart or Target are nearly as glorious as Costco, which we'll see in a minute. Look at this. Your cash and cash equivalents from 5.9 down to just $2.2 billion. Are we serious? Look at your inventory. That relatively under control over the last year, from 13.9 to 13.5. So they've done a nice job not continuing to build that up. But your cash over the last year down $3.7 billion. That is like shaved more than in half. You definitely wouldn't want to do that again for Target over the next year. Your long-term borrowings coming in at $16 billion. This is a company that doesn't look as financially healthy as certainly Walmart and definitely Costco. When you come here to cash flows, paints a very similar story. So your net earnings went from $6.7 billion down to, we'll call that $2.8 billion. You come down here to your net cash provided by operating Target. That was shaved in half by 50%, from $8.6 billion down more than 50%, down to about $4 billion. The problem is, guys, is the company still has to invest into the existing locations and building out new ones to the tune of $5.5 billion. So you're negative on a run rate on cash there. Your business operated at a $4 billion rate, and you spent $5.5 billion just before you pay any interest on your debt, your dividend, and do what, in my opinion, probably an egregious share buyback over at Target. You're already negative from a cash perspective. Last year, again, they could rein that back. Maybe this year, I know the Target in my town was recently renovated, so maybe they're going to walk that back. But look, even last year, they spent $3.5 billion. That would leave very little cash left for everything else. They had to add to the debt position over the last year at likely not very favorable rates, certainly where they've been over the past decade, to the tune of $2.6 billion. You're paying dividends over here to the $1.8 billion. And you're still rebuying the stock. They need to stop this. $2.8 billion. Last year, you see that they did kind of more or less pause this. Last year, they bought back $7.4 billion. This year, they did $2.8 billion. I'm going to tell you what Target is going to have to do. If these results continue with Target, what they're going to do is they're going to reissue the shares of Target that they spent shareholder money on buying back over the past 2 years. They're going to have to raise cash over at this company if they're not going to go to the debt markets. This company really should stop buying back the stock. The dividend is fine to a certain degree, but they've got to stop buying the stock back over at Target. And look, from an executive compensation perspective, we're talking about just $220 million over the last year. This isn't a tech company that is diluting you by paying the employees and the executives. It's basically nothing from a dilution perspective. So this buyback is very much egregious, and Target needs to cut that out, and it would need to cut that out before I would invest in this company personally. Now, from a technical perspective, it is... I mean, you're on a cliff on this one, okay? The longer term trend with Target, so what's a dangerous thing from a technical perspective is when you're kind of on these longer term or these very steep uptrends and then they break. So the problem is they break, they tend to back test to the top, and then this one kind of broke down. And now, yeah, in the micro trend with Target actually looks pretty good. You've got a higher set of lows, higher set of highs, not really confirmed here. My worry is this one's going to leg down, and believe it or not, and I'm sorry if you own Target shares, but there's an area of consolidation down here south of $80. You've got the low point of the pandemic down here at about $90. In my opinion, if this company isn't able to turn things around from a financial perspective, this is ultimately where the shares are heading. If they're not able to turn around this net income, because again, we're talking about a company worth $76 billion. I just showed you the financials. We have $4 billion worth of positive cash flow for a full year. So you're paying basically 20 times cash flows. You come up here to earnings and you're south of $3 billion on net income for a full year. So you're paying like, what, 30 times forward earnings over a target? And management in their guidance literally couldn't tell you if the business is going to go down or going to go up. That, in my opinion, makes Target a little bit risky. Now, if you're willing to go on that ride, you're willing to take that risk, there could be some reward there. But in the retail sector, I don't like the risk reward trade. I like the safety trade. I like to collect those dividends. I like to collect those buybacks. And so in that case, I'd much rather go for another retailer until Target cleans up their act. Now, speaking of the retailer that I continue to hold, in fact, I have never sold Costco. And I think as we move through these financials, I think you'll see why I've never sold Costco. While I have sold Walmart in the past, I've definitely sold Target in the past. I have never sold Costco. Now, over the last year, stock's down about 11%. Year to date, it's gotten back a little bit of that, up about, we'll call that 5%. The company reported their Q2 earnings back just on March 2nd. Revenue came in at $55.3 billion. That was a whopping 6.5% increase year over year, although it did miss expectations by about $340 million. Now, when we look forward to subsequent quarters for Costco, we're looking at about 5% growth. Now, Wall Street is expecting to maintain at least kind of mid to high single-digit growth rate on that revenue side for the subsequent quarters. We'll see if Costco is able to deliver it. Now, the company probably thinks that it will, as it approved a $4 billion worth of buyback. Now, the company already had a $4 billion buyback program, which they've used approximately $1.4 billion of that. They essentially just extended that, added the 1.4 back, and now you've got another $4 billion essentially there to buy back the stock. When we get over here to the financials, you'll see that this company likely is in a position to do that. Now, this was back on the last earnings call. The company's CFO says the membership fee hike is a question of when, not if. And I'm not a member of Costco, but I'm assuming they haven't quite done that yet. And when we get over here to the financials, you'll see the importance of that membership fee hike if and when it comes down the pike. Total revenue, as we said, came in at this $55.3 billion. Again, that was about 6.5% growth year over year, over about $52 billion a year ago on a quarterly basis. Now, what this company has seen, just like Target and Walmart, is their operating expenses are basically outpacing or very much keeping up with the growth that they're seeing on that revenue side. Now, Costco's in a little bit better position as they went from $45 billion to $48 billion on those cost of goods. And then your employee costs went from 4.6 up to 4.9. So our operating income did tick up over here. So despite the environment that we're in, Costco just does such a great job operating their business, up just fractionally from 1.8 to 1.9. But this kind of relates to the previous story that I talked about, that they're going to raise this membership fee. And then you see the membership fees on the revenue side coming in at $1 billion. So let's say you raise them 10%. Okay, yeah, there's going to be some people that churn off when you raise the fee, but you know, there'll be some people that join Costco over that period of time. So you can add $100 million right here. So that would get you up over $2 billion. When you look for the full year, you've got $2 billion worth of membership fees. That means you could potentially add, again, if they raise it 10%, maybe they raise it 5%, maybe they raise it 20%. There's all kind of ways you can model this thing, but you could be potentially, raising your net income or your operating income considerably. Actually, this is for I think I said full year. This is just for 6 months or so. So you could be raising the full years by like $300, $400, $500, $600 million on that operating side just by raising this membership fee. So that'll be a very exciting. Now, it probably is priced into Costco to a certain degree. Everybody's already seen the CFO's comments. They understand that this rate hike is coming at some point. So I wouldn't expect the stock to react violently on the day they do announce those types of things. But from a financing perspective, just a beautifully run company. Now, what's different from Walmart and absolutely Target is this company actually runs at a positive from their net interest expense. They spend just $34 million in a quarter, but because they have more cash than they do have debt earning money, they actually earn $114 million. So you come down here to net income, it paints a pretty darn good story. And then when you get over to the balance sheet, this is the most financially healthy company of the trio, certainly compared to Target. This is the one that I would invest in if you're worried about a balance sheet. They have a boatload of cash to the tune of over $13 billion. They've done a nice job over the last year controlling their inventory. In fact, this is the one of the group that's actually meaningfully kind of declined their inventory, although this is not a comparable period back from August. You'd expect some inventory building up and it be depleted over the holiday season, but they've done a nice job, needless to say, over the last year. And then when you come down here to long-term debt, they don't really have a whole lot in comparison to the amount of cash that they have on. Just $6.5 billion worth of debt down here. The current portion is basically a rounding error. So this company from a financial perspective is extraordinarily healthy. Now, the one thing that I would push Costco's management to do is actually give us a cash flow readout, which they don't do considering the stock is being bought back. That would be an interesting thing to look at, but you can see evidence of just a very small amount of shares over the last year being diluted out of the company. So they're doing a nice job over at Costco, very financially healthy company. If you're looking for probably the best financial health company in the retail segment, that would be Costco. And it's represented on the stock chart. A lot of times, we talk about the fundamentals, and here's a perfect example of this company's fundamentals are fantastic, certainly in relation to the sector that it operates in. And here's shareholders rewarding it. Look at this chart, folks. This goes back to 1986. I was just 4 years old back in 1986. Some of you might not even were born then. And look at this. I've put these channel lines in here. They're not in here accurately, but what this shows you is I'm on a weekly chart with Costco, and almost all the charts, yes, the stock is blown off to the top every once in a while, but you don't really actually see those kind of large kind of blow-offs to the bottom with this stock. And I would say as an investor, that's much more important. Yes, the stock does blow off to the top every once in a while, but almost every single one of the candles over the past, we'll call it 40 years with this company, fits inside a very tight channel. So this makes it very easy, very, very easy to know when you need to buy Costco. You buy it at the bottom of the channel. Now, the interesting thing about a channel is if the stock goes sideways at this level at 475, well, it basically will be at the bottom of the channel. We'll call it by the end of the year or so. So you don't have to feel bad buying at the middle of the channel, but obviously maybe you're less aggressive. If you wanted 10 shares of Costco and you wanted to start your position today, maybe you peel off 2 or 3 shares here. You wait to see, because again, in the shorter term, if we're looking at a very, very micro trend of Costco, they are making a series of lower highs here. It's not really being confirmed with lower sets of lows, but this stock is kind of flagging out. Looks like it wants to head a little bit lower, although sometimes these formation shoots you higher. But this is a stock, in my opinion, you buy and hold. This is a stock I have in my son's portfolio where you lock it away for 15 to 20 years, and then when they want to take that money out and go blow it on something silly, it'll be there and likely be a larger amount has grown for them. As again, the 40-year stock history of Costco is proving that, and there's no reason looking at these fundamentals and eventually a price increase on that membership side that these fundamentals are going to deteriorate at all. And then you have competition like Target where their financials are looking almost disgusting, and so there's certainly going to be some opportunities for Costco in the coming weeks and months and quarters ahead. Hopefully you guys enjoyed today's video. That was a view at the retail sector. We'll be back again later this week and combo up some other stocks in different sectors. Hopefully you enjoyed today's video. Enjoy your weekend. Good luck with your investments.